Two people, same income, $100,000 each in a single year. One pays 32% in taxes. The other pays 15%. Neither broke a single rule. The tax code was written that way on purpose. Picture two people. Both earned $100,000 last year. Person A worked a job, salary, W-2, standard employment. Person B earned the same amount primarily through investment gains and dividends. At the end of the year, Person A's effective tax rate was approximately 32%. Person B's effective tax rate was approximately 15%. Same income, more than double the tax burden on one of them. Most people assume this kind of gap requires something illegal, an aggressive loophole, a clever accountant, some kind of trick. It requires none of that. It requires only one thing: earning your income in a category the tax code treats favorably versus a category it does not. The tax code is not neutral about how you make your money. It has clear preferences. And by the end of this video, you will understand exactly what those preferences are, why they exist, and what tools inside that same tax code are actually available to you, regardless of where you currently stand. Let us start with the distinction that explains everything. To understand why this gap exists, you need to understand a basic distinction built into every modern tax system: earned income versus capital income. Earned income is money you receive in exchange for labor, a salary, hourly wages, self-employment income from active work. Capital income, on the other hand, is money you receive from owning something. Capital gains from selling an asset that increased in value, dividends from owning stock, rental income from owning property, interest from certain investments. Here is the critical difference in how these are taxed. In the United States, earned income is taxed through a progressive system with rates that climb as high as 37% at the federal level, before payroll taxes, which add further costs specifically to earned income. Long-term capital gains, profit from an asset held more than 1 year, are taxed at a maximum federal rate of 20%. Qualified dividends receive the same favorable treatment. The difference between the top earned income rate and the top capital gains rate is 17 percentage points, on the exact same dollar amount. This is not an accident of tax history. It is a deliberate policy choice that has existed in various forms for over a century. The stated justification has typically centered on encouraging investment, capital formation, and economic growth. Whether that justification holds up under scrutiny is a genuine economic debate. What is not in debate is the outcome. A person whose income comes primarily from owning assets pays a meaningfully lower rate than a person whose income comes primarily from selling their labor. Now, here is the detail that makes this structurally important to understand. The vast majority of working people generate income almost entirely through labor. The vast majority of wealthy individuals generate an increasing share of their income through capital. The tax code did not create wealth inequality. However, it consistently amplifies it every single year. Now, let us talk about how this distinction came to exist. Because tax law is not handed down from an objective authority, it is written by legislators. And legislators are influenced by the people who fund their campaigns, lobby their offices, and shape the policy debates they participate in. The capital gains preference in the United States dates back, in various forms, to the early 20th century. However, its modern structure was significantly shaped during periods of intense lobbying from investment and financial industry interests. Here is a detail worth sitting with. The lobbying expenditure of the finance, insurance, and real estate sector in the United States has consistently ranked among the highest of any industry, totaling billions of dollars annually across decades. This spending is legal, it is disclosed, and it is part of the standard process of democratic policymaking. But it produces an outcome worth naming clearly. The industries and individuals with the resources to fund sustained lobbying efforts are disproportionately the same individuals who benefit from the capital gains preference those lobbying efforts helped shape and preserve. This is not a conspiracy theory. It is a description of how policy gets made when one side of an issue has significantly more resources to advocate for it than the other. Wage earners, as a group, do not organize multi-billion-dollar lobbying campaigns to advocate for lower payroll taxes or higher rates on capital gains. The collective action problem is real. Millions of individual workers each have a small personal stake in the outcome, whereas a smaller number of wealthy individuals and institutions each have an enormous personal stake in the outcome. Concentrated interest with high stakes consistently out-organizes diffuse interest with low individual stakes. This dynamic is not unique to tax policy. It explains a significant portion of how policy outcomes diverge from what a simple majority vote on the underlying question might produce. And here's what makes this particularly durable. Once a tax preference exists, and a group of taxpayers has built their financial planning around it, removing that preference becomes politically costly. The beneficiaries defend it vigorously, consistently, across election cycles. The people who would benefit from removing it often do not know it exists clearly enough to advocate against it. That asymmetry of awareness is, in its own way, as important as the asymmetry of lobbying spending. If understanding who shaped this system changed how you see your own tax bill, stay with me, because knowing how the system was built is one thing. The legal tools inside that same tax code, the ones available to ordinary people, not just the wealthy, that is what comes next. And there are more of them than you think. Here is where this becomes genuinely useful, because the tax code does contain tools available to ordinary wage earners. The problem is not that these tools do not exist. The problem is that they require specific knowledge to use, and that knowledge is not distributed evenly. Start with retirement accounts. Contributions to traditional 401k and IRA accounts reduce your taxable income in the year you contribute. This is, in effect, a tax preference available to any wage earner with access to these accounts. The wealthy use these accounts too, but they also layer additional strategies on top of them that most wage earners never learn exist. Health savings accounts, where available, offer triple tax advantages. Contributions reduce taxable income, growth is tax-free, and qualified withdrawals are tax-free. Most eligible workers do not maximize these accounts because most workers were never taught what they actually do. Now consider the home mortgage interest deduction, available to homeowners who itemize deductions. Real estate, even at a modest scale, opens access to depreciation deductions, a tax benefit that allows property owners to deduct a portion of their property's value against their income each year, even while the property itself may be appreciating in market value. This benefit exists for anyone who owns rental property, not exclusively for the wealthy. But accessing it requires understanding that it exists, understanding how to structure the ownership, and often requires working with a tax professional who can navigate the documentation correctly. The wealthy do not have access to a separate set of laws. They have access to professional guidance that translates the existing laws into action. A tax attorney, a CPA who specializes in tax strategy, a financial planner who understands the interaction between these provisions. This guidance has historically been positioned as a luxury service for people who already have significant assets. Increasingly, it is becoming accessible to people earlier in their financial lives, through lower-cost professional services and through public education that explains these mechanisms in plain language. The tools are not exclusively for the wealthy. The translation has been. That is beginning to change. Here is what changes when you understand the tax code structurally. The first move is maximizing every tax-advantaged account you already have access to: employer retirement match, traditional or Roth contributions, and health savings account if your insurance plan qualifies. These are not advanced strategies. They are available right now to almost any wage earner, and most are significantly underused simply because nobody explained their full value. The second move is understanding that even modest capital ownership changes your tax treatment. You do not need to be wealthy to receive capital gains treatment. A small portfolio of index funds, held for more than a year before selling, qualifies for the same favorable long-term capital gains rate available to a billionaire. The rate is not means-tested. It applies to the type of income, not the size of the bank account. The third move is treating tax literacy as an ongoing practice rather than a once-a-year panic in April. The provisions in the tax code that benefit ordinary people are documented in public, free government resources. They require reading, not wealth. The structural gap is real. However, the specific tools available to you, right now, are larger than most people ever discover. Start using them. The tax code was not written with you as the primary beneficiary. That much is structurally true, but it was also not written to exclude you entirely. The tools that exist inside it for ordinary people are real, legal, and significantly underused. Not because they are hidden, but because nobody walked most people through them clearly. Now someone has. Share this with one person who has never compared their effective tax rate to anyone earning differently than they do. And if you want to keep understanding the systems built around your money, subscribe to Hidden Truth Files. Hidden, no more.